Okay, hi there, it's Jeff back again with another in our series of key diagram videos. We're working through some of the major micro topics at the moment and thinking about the diagrams that will make a big difference to your exam. Now, this is a key one, a really important one. Let's spend a few minutes together thinking about monopoly and allocative efficiency. So businesses with monopoly power can set high prices, certainly higher than you would expect in a competitive market. And an unregulated monopoly supplier is pretty much likely to be allocatively inefficient because the price that they're able to charge is greater than the marginal cost of supplying the good to the consumer. They can use their market power to price above marginal cost. In a competitive market, however, the forces of competition act to lower prices often, and therefore more consumers will benefit from purchasing the good. You see, as falling prices happen, people's real incomes go up and more people can afford to buy the product. Their effective demand goes up. But in theory, it's quite important, a monopoly results in a deadweight welfare loss of consumer and also producer surplus. We're going to focus on consumers in this short video. So here's the classic monopoly diagram with profit maximization output of Q1. The monopolist is able to to price at P1. The cost per unit is C1, and they're making supernormal profits, shown by the orange shaded area. Let's throw a few letters in here, because letters are important in exams. Please use letters whenever you can. So there is a loss of welfare. You see at price P1, output Q1, there's a loss of welfare because the price equals the marginal cost at point B. So if the price was lower and output higher, there will be more consumer surplus. So in fact, the welfare loss traditionally for monopolists is that area A, B, C, a welfare loss of consumer surplus. It's probably easier to see just by making this little tweak to the analysis. So if you draw this diagram in the exam, please do remember to tell the examiner that you're dropping the assumption of diminishing returns. Instead, you're replacing it with the assumption of constant returns. In other words, you're saying that the cost of production per unit is uniform, it's the same. Effectively, the supply curve becomes perfectly elastic and marginal cost equals average cost. This takes away a little, little curvy curve bits and makes it a little easier to draw in the exam. So the profit maximizing output is, again, Q1, and they can charge price P1 and make a profit equal to the area P1, B, C, D. Okay, so that's as before. The price they can charge is well above the marginal and the average cost of supply. As a result, because price is greater than marginal cost, there is a loss of allocative efficiency. The deadweight loss of consumer surplus, or the welfare loss, is shown by the area B, C, E. If prices were lower, if prices were closer to cost, output would be higher than Q1 and we could bring more consumers into the market. And therefore, if the market price instead was to be price D instead of price P1, this would lead to an expansion of demand. You move down the demand curve to an output of Q2, the intersect of marginal cost, average cost, and average revenue. Of course, that's where normal profits are made. Normal profits get squeezed away, competed away, and you end up at output Q2. As a result, there would be an increase in consumer surplus. Originally A, B, P1, it would increase to A, E, D because the supernormal profit of the firm gets competed away by lower prices. Hence, if you price at marginal cost, you can eliminate the deadweight loss of welfare. So when revising monopoly power ahead of your exams, please remember to include the various economic efficiency concepts: allocative efficiency, productive efficiency, dynamic efficiency. Are you happy with those three? If you are, great stuff. If not, time for revise. In theory, a monopoly can lead to an inefficient allocation of scarce resources, but of course a lot depends on the actual pricing strategies used by the firm. They may not necessarily just sell at one price. They could price discriminate, for example, or they could be regulated, or there could be a degree of contestability in the market where the monopoly is basically you can't charge the top price when it wants to. So much depends on the pricing strategies used and also whether the firm with the market power faces a degree of contestability. And of course, as you'll know, monopolists can have their prices regulated by an industry regulator. So there we go, monopoly and allocative efficiency. Thanks for joining in this revision video. Take care, see you soon.